Okay guys, Jason here again from Alliance Corp. Got another great quick video for you. So the question from our viewers, how much tax can I get back from my investment property? So obviously this is one of the great advantages about investing, and the government wants to give you these tax credits to incentivize you to invest because they just simply don't want to pay you the pension in retirement. They need you to be self-funded. The tax credits can be significant. So have a look at how much tax you currently pay. On an income of $100,000, you'd be paying around $26,000 a year. That's over $250,000 in tax every 10 years. That's crazy, guys. You know, the people say this, death and taxes, they're the two things you can't avoid, but it's not true. Buy investment properties and you can get that tax back. Now I'm going to run through the figures here. It's going to be a quick video, so if you don't quite get it, that's okay. Just go back and play it again. So let's have a look at how the tax credits works. First thing we do is we start off with a property. So this particular property that we purchased is around $500,000. This property is a house and land package, very popular with families at the moment. The rental incomes are a little bit high because it's a newer property, and also too you get maximum depreciation. So if you want higher tax credits, go for properties with strong depreciation. The other thing to consider is that we're receiving rental income. So on this particular property we're receiving $21,000 per annum in rental income. The interest repayments on the loan on the property, and this particular property we're not putting any cash in. So this investor has borrowed all the funds. They took the deposits and stamp duties from the equity in the home, which was borrowed funds, and then they had the investment loan on the property. So it's 100% borrowed funds here. Then we've got some rental expenses of $6,000. That's things like your property management fees, insurances, your rates, things like that. If you have a look at your pre-tax cash flows, with rental income of $21,000, that doesn't cover your interest repayments and your rental expenses. You actually have a negative cash flow position of $10,000. All right, so don't let that bother you, because most investment properties you buy, it's very rare that the rental income will cover all the costs of owning the property before you get those tax credits. Most properties have, are negatively geared. The next thing we have a look at is your non-cash deductions. So this is where the government will give you tax credits based on the depreciation on the property. So on the building itself, the structure, where most of the depreciation is, you'll get 2.5% depreciation over 40 years. That's a long period to keep getting back those depreciation credits. In this example, it's roughly $5,000. You'll also get depreciation back on the fittings and fixtures, but they have a much shorter lifespan. So that's things like your carpets, your appliances, your fittings, fixtures, things like that. That's another $5,000. On average, you claim that back over a 5 to 10 year period. Then you can also claim things like your loan costs. In this example, you may have done a 90% lend, which means you pay some lenders mortgage insurance, etc. So that's roughly $3,000 over a 5 year period. So your total deductions with this particular property is $44,000 per annum. However, remember that we're receiving rental income of $21,000. So if you deduct the $21,000 rental income from the $44,000, you'll end up with a negative cash flow position on the property of roughly $23,000, made up of cash deductions and non-cash deductions. That $23,000 is then deducted from your salary, your current income. So if you're earning an income, this particular investor has a salary of about $120,000. What the government will allow you to do is deduct that $23,000 from your $121,000. So instead of paying tax on $120,000, you'd be paying tax on just under $100,000. So that means you would save the tax that you'd normally pay, which is at 37% on that marginal rate. $23,000 at 37% is $8,500. So they're your tax credits, all right? $8,500, that is significant. You know, if you think about that on an income of say $100,000, you only need roughly 3 properties, and you're no longer paying any tax. Now that $8,500 goes back into the portfolio to help cover some of your negative cash flows. So if you deduct the 8.5 from the 10, that leaves you with a net negative cash flow position of about $1,500 per annum. If you break it down, it's roughly $28 a week. So this property would cost you $28 a week. It's not a lot. Often that $28 a week can come from the equity or your master facility, so often you don't have to put any money in at all. And this particular property in this location is targeted for high rental incomes, high tax deductions, so it's more neutrally cash flow, but also we get some good capital gains in that particular location. So guys, that's how the tax works. Keep watching the video, and remember, death and taxes, it's rubbish. You don't have to be paying any tax, right? Just get out there and buy some investment properties. Jump on the website, you can order more ebooks, learn about this stuff. Happy investing, I look forward to speaking to you soon.